Marcus was 29 years old, a high school history teacher in Columbus, Ohio. He'd been investing for 2 years, mostly in tech stocks, and watching his $14,000 portfolio swing up and down by thousands of dollars in a single week. Some nights he'd check his phone at 2 a.m., just to see how the market was doing. Then a colleague mentioned something he'd barely thought about since his economics class: bonds. Within a year, Marcus restructured his portfolio, stopped losing sleep, and built a much more stable financial foundation. Today, we're going to break down exactly what bonds are, how they work, and why they might deserve a place in your portfolio too. Think of a bond like this. Imagine your neighbor needs to borrow $1,000 to fix their roof. They promise to pay you back in 5 years, plus $50 every year for the trouble. That's essentially what a bond is. When you buy a bond, you're not buying ownership in a company. That's what stocks do. Instead, you're acting as the lender. The borrower, whether it's the U.S. government, your city, or a corporation, promises to pay you a fixed amount of interest, called a coupon, on a regular schedule. And at the end of the bond's term, called the maturity date, you get your original investment back. This is exactly the concept that Marcus's colleague introduced to him, and it clicked immediately. Let's lock down 4 terms you'll hear constantly in the bond world. First, face value, also called par value. This is the original amount of the loan, usually $1,000 per bond. Second, the coupon rate. This is the annual interest rate, expressed as a percentage of face value. So, a 5% coupon on a $1,000 bond means you get $50 per year. Third, maturity date, the date you get your face value back. Bonds can mature in as little as 1 month, or as long as 30 years. And fourth, yield. This one's a little trickier. Yield is your actual effective return, which can differ from the coupon rate depending on what price you paid for the bond. Marcus had to spend an afternoon with these 4 terms before everything clicked, but once it did, he was sold. Not all bonds are created equal, and Marcus quickly learned there are 3 major types he needed to understand. First, Treasury bonds. These are issued by the U.S. federal government and are widely considered among the safest investments available because they're backed by the full faith and credit of the United States. They come in short-term Treasury bills, medium-term Treasury notes, and long-term Treasury bonds up to 30 years. Second, municipal bonds, or munis, are issued by state and local governments, often to fund schools, roads, or public projects. One big perk: the interest is usually exempt from federal income tax. And third, corporate bonds, issued by companies like airlines, retailers, or tech firms. They typically offer higher interest rates than government bonds, but they also carry higher risk since companies can, and sometimes do, default. Here's the chart that stopped Marcus in his tracks. This is the 10-year U.S. Treasury yield over recent years, and it tells a powerful story. When interest rates were near zero in 2020 and 2021, bonds weren't offering much. But as the Federal Reserve raised rates aggressively starting in 2022, Treasury yields climbed dramatically, at points offering over 4 and even 5% annually with essentially zero default risk. For Marcus, this meant that the boring bonds his parents talked about had suddenly become genuinely competitive income-generating investments. Historically, the 10-year Treasury yield has averaged around 4 to 5% over decades. This is live data pulled from the Federal Reserve, and it shows why bond conversations are back in full force. Here's one of the trickiest concepts in bonds, and honestly, the one that trips up most beginners. Bond prices and interest rates move in opposite directions. Here's why. Imagine you buy a bond today that pays a 3% coupon. Then next year, interest rates rise and new bonds are paying 5%. Suddenly, your 3% bond looks less attractive. So if you wanted to sell it, you'd have to discount the price to make it worth buying. The reverse is also true. If rates fall, your existing higher rate bond becomes more valuable. Now, and this is crucial, if you hold your bond all the way to maturity, none of this matters. You'll still get your face value back. This is exactly what Marcus learned when he asked why one of his bonds had dropped in value even though he hadn't done anything wrong. The answer was simply that rates had moved. Let's look at the data side by side. This chart compares the average annual returns of three major asset classes over a long historical period. Stocks, represented by the S&P 500, have historically returned around 10% annually on average, before inflation. Long-term U.S. Treasury bonds have returned roughly 5 to 6%, and short-term Treasury bills have come in around 3 to 4%. Now stocks clearly win on raw returns. So why would anyone own bonds? Because of something Marcus experienced firsthand: volatility. In 2022, the S&P 500 fell about 18%. That same year, having even 20 to 30% of your portfolio in bonds would have significantly cushioned the blow. Bonds aren't about maximizing returns. They're about managing risk and maintaining stability, especially as you get closer to needing your money. Here's the number that stopped Marcus mid-scroll. If you were to invest $100,000 into a bond ladder, that's a strategy where you spread your money across bonds with different maturity dates. At an average yield of 4.6%, you'd collect approximately $46,000 in interest payments over 10 years. And at the end, you'd still have your original $100,000 back. No stock picking, no market timing, just steady, predictable income. Now, not everyone has $100,000 to start, but the principle scales. Even $10,000 in bonds at current yields could generate $4,600 in interest over a decade. This is the power of fixed income investing, and this is exactly what convinced Marcus that bonds weren't boring. They were strategic. Remember how Marcus was worried about interest rates changing? The bond ladder strategy is one of the most practical ways to manage that concern. Here's how it works. Instead of putting all your money into one bond with one maturity date, you spread it across multiple bonds that mature at different times. Say 1 year, 3 years, 5 years, 7 years, and 10 years. Every time a bond matures, you reinvest that money into a new bond at whatever the current rate is. This means you're never fully locked in at any single interest rate for too long. You always have cash freeing up and being reinvested. Marcus started small. He put $2,000 into 3 Treasury bonds with different maturities using treasurydirect.gov, which lets everyday Americans buy bonds directly from the government with no broker fees. It was simpler than he expected. Not all bonds carry the same risk, and this is where credit ratings become your best friend. 3 major agencies, Moody's, Standard & Poor's, and Fitch, assign letter grades to bonds based on how likely the issuer is to repay. AAA is the gold standard. The U.S. government holds this top rating. As ratings drop toward BBB, the risk of default gradually increases, but so do the yields offered. Below BBB, you enter what's called high yield, or, more bluntly, junk bond territory. These bonds can pay significantly higher interest, but they come with meaningful default risk. For Marcus, who was prioritizing stability after his sleepless stock nights, he stuck to investment-grade bonds, specifically U.S. Treasuries and a few highly rated corporate bonds. All investments carry risk, and higher yields almost always signal higher risk. That's just the math of markets. This is the chart Marcus printed out and actually pinned above his desk. It shows portfolio performance during the 2022 market downturn for 2 different portfolios. A 100% stock portfolio, using S&P 500 data, fell roughly 18% that year. But a classic 60-40 portfolio, 60% stocks, 40% bonds, fell significantly less, cushioning a meaningful portion of those losses. The bonds didn't just sit there, they acted as a shock absorber. Now, it's important to note that 2022 was also unusual because bond prices fell too as interest rates surged, so the 60-40 portfolio did still decline. But historically, in most downturns, 2001, 2008, 2020, bonds held their value or even gained while stocks dropped. The data shows that diversifying with bonds has historically reduced portfolio volatility over time, even if it slightly lowers long-run returns. This is for educational purposes only, and your ideal allocation depends on your personal situation. So how does someone like Marcus, or you, actually get started? There are 3 main ways. First, treasurydirect.gov. This is the U.S. government's official website where you can buy Treasury bonds, notes, bills, and I-bonds directly, with minimums as low as $100 and no fees. It's where Marcus made his first bond purchase. Second, through a brokerage account. Platforms like Fidelity, Schwab, or Vanguard let you buy individual corporate and municipal bonds, typically in $1,000 increments. Third, and this is the approach many beginners prefer, bond ETFs. An ETF like BND or AGG is a fund that holds hundreds or thousands of bonds at once, trades like a stock, and can be purchased for the price of a single share. Bond ETFs offer instant diversification without needing to manage individual bonds. Marcus actually uses all three methods today, depending on his goals. Here's a number that puts everything in perspective. The U.S. bond market is approximately $53 trillion in size, making it actually larger than the U.S. stock market. Institutional investors, pension funds, insurance companies, university endowments have long relied on bonds as foundational holdings. The fact that most individual investors barely think about bonds is one of the biggest gaps in everyday financial literacy. When Marcus first heard this number, he said it made him feel like he'd been ignoring half the financial world. The bond market is where governments finance themselves, where corporations raise capital, and where millions of retirees generate steady income. It's not just for Wall Street. It's for anyone who wants a more complete investing strategy. So the big question, should you own bonds? The honest answer is, it depends on your age, timeline, and risk tolerance. A common rule of thumb that many financial educators reference is to hold a percentage of bonds roughly equal to your age, minus 10. So at age 30, that might mean about 20% bonds. At age 55, maybe 45%. This isn't a hard rule. It's a starting point. Younger investors with decades before retirement can often tolerate more stock volatility because they have time to recover from downturns. But as you approach retirement and start depending on your portfolio for income, stability matters more. For Marcus at 29, his colleagues suggested a modest 15 to 20% allocation in bonds. Not enough to dramatically limit growth, but enough to add a real cushion. Please consider speaking with a licensed financial advisor to determine the right allocation for your specific situation. Today, Marcus's portfolio looks very different from the all-stock roller coaster he was riding 2 years ago. He's got about 20% of his money in a mix of treasury bonds and a broad bond ETF, and for the first time, he actually sleeps through the night when the market drops. He didn't need to become a bond expert. He just needed to understand the basics. Bonds are loans that pay you interest. Prices move opposite to rates. Credit ratings tell you how safe a bond is. And there are multiple easy ways to get started, even with a few $100s. Here's what to take with you today. Bonds aren't just for retirees or Wall Street pros. They're a tool for building a more resilient, balanced portfolio at any stage of your financial journey. If you found this useful, hit subscribe. We drop new videos every week on building real wealth with knowledge, not guesswork. Everything you've seen in this video is for educational purposes only and does not constitute financial advice. Always consult a licensed financial advisor before making investment decisions.